All right, cool. Let's start because we have a lot of ground to cover. So welcome to another webinar, Into the Block webinar, where every 3 weeks we try to focus on some of the most important topics in the industry. This time around, we're gonna talk about the current state of institutional DeFi, which is an area obviously that we devote a lot of attention. So specifically, what are the challenges and opportunities in institutional DeFi? The agenda is very, very simple. So we're gonna talk to give provide a pragmatic view into the institutional DeFi space. What are the key challenges? I have this thesis that institutional DeFi needs something the equivalent to what BIDO did for tokenization. So we're gonna talk about that and why. And then two paths that we think are somewhat concurrent to address the challenges in institutional DeFi. As always, we're going to try to cover this in a short period of time. You can stop at any time for questions, use a Q&A panel, or team is monitoring it, and we're going to stop throughout the presentation for to answer some questions. Before that, let's do a quick update about Into the Block in the last 3 weeks. So on the analytics platform, we launched a couple of interesting perspectives. One was about the Mt. Gox holdings, which they were causing a lot of noise in the market in terms of the dumping of Bitcoin holdings. So if you go to this URL, you can see a very detailed analysis of the activities related to those holdings, and complementary. We also released something very similar for the Genesis holdings are going through the bankruptcy process, so you can get a lot of insights about that activity. On our economic risk monitoring platform, we've released the dashboards for Aave Lido, the new Aave V3 version that we collaborated very closely with the Aave team on. So you can see a lot of risk signals there. We also released the risk radar for Reserve protocol, one of the most interesting protocols in Ethereum mainnet with 170 million TVL. And now you can monitor a lot of the risk activity related to Reserve there. One of the most interesting developments in ITV in the last few weeks was our collaboration with Aave, in which we partnered with the Aave DAO to deploy liquidity via our Smart Yields platform into the new version of Aave Lido. And in the first week, we deployed over 100 million. Our clients did, of course. And now we're extending that partnership. We develop a series of strategies, but also the risk models associated with that. That is what you can see in the Aave Lido risk radar. And that's a quick update about ITV. In the next few days, you're gonna see things like new risk radar releases for Swell, Puffer, Gearbox. We have some new analytics things that are also being released, and obviously we have some interesting developments on the DeFi institutional side. We're going to be launching new strategies in Solana that we're particularly excited about. With that, I would like to move to the topic of the webinar, and I start with a very pragmatic sort of assessment of the current state of DeFi from the institutional standpoint. So the way DeFi V1, right, the DeFi summer of 2021, it was mostly dominated by two fundamental primitives, AMMs, automated market makers, and lending. There was activity in other areas, but by far those were the most important one. And when you look at those protocols, they were in general very big, monolithic. The functionalities were very basic: Uniswap, data, and X plus Y equals K type of linear formula to balance the books. However, they were technologically very complex. If you look at a protocol like Aave, it has like 100 and something risk parameters that you can adjust, and the communication between these protocols was not particularly good. So there was a lot of very limited interoperability, which from a capital formation standpoint translates into capital fragmentation and things like that. Obviously, we went through like a very acute crisis over the 2022 and 2023, but during that time, a new sort of generation of DeFi protocols started emerging. So these days, you observe trends in protocols like Morpho Blue, like Uniswap before it, that they're more modular, smaller, more extensible. I actually wrote an article in CoinDesk calling this trend micro primitive. But somehow that's happening. Like you have a lot of more customizations that you can do. The protocols are simpler. However, you were seeing the emergence of more sophisticated capabilities like leverage with protocols like Gearbox, derivative with protocols like GMX and DYDX, fixed term learning with protocols like Term. So we're seeing an expansion in terms of the coverage on primitive, and then interoperability is getting better. So it's not unusual these days to find collaborations between protocols like Aave Lido or what is happening in the EigenLayer ecosystem. And for the most part, particularly, I hope, triggered by what happened in 2022, protocols are getting more serious about risk management, and you're seeing many that are taking a long time to build the appropriate risk constructs in the platform. Now, so that's the state of DeFi. How does that translate from an institutional DeFi standpoint? So this is the area that we do the bulk of our work. And the sad reality is that a few years after the DeFi summer, the institutional adoption in DeFi remains very low. It's mostly within crypto institutions, but you don't find many traditional finance institutions coming to DeFi. And most of the adoption, it remains on extracting yield and extracting alpha, but not about constructing and building utility in the ecosystem. Now, in conferences and the omnipresent explanation as of why this is happening, it was there is a limited KYC, AML, and capabilities that are hard for institutions to get comfortable with, and also a somewhat aggressive regulatory climate. I believe that's really not precluding institutional adoption. So I will gamble to say that if KYC and AML was solved today, it still will have the same issues that we have. So it's one of the things that we need to solve, but it's not by far the most important one. So the reality is that there is very few institutional grade capabilities in the current version of DeFi. So KYC and AML might appease some compliance people, but it's still not enough to attract institutional capital at a scale. If you doubt my explanation, I don't know if you remember this, right? A few years ago, Aave tried to launch this thing called Aave Arc that was a KYC AML ready version of the protocol for institutions. And I remember I got a lot of hate messages because I said at the Avalanche Summit in Barcelona that this was never going to work, that it was going to be 4 hedge funds playing with each other, and it's pretty much what happened, because KYC AML is just not enough. There is many capabilities that were missing. So capital efficiency in DeFi is really bad. There is plenty of technical economic risk. Capital is super fragmented across many ecosystem. Just investment products in general, they're few and far between. If you think that something like what ETFs did for traditional investment, that sort of democratized complex portfolios of equities and commodities in a single vehicle, we need something like that. Right now, there is a lot of work that needs to take place for people to invest in DeFi, and the user experience. And I'm not saying from a wallet standpoint, just the number of steps to get something done in DeFi, it's fundamentally difficult for most teams. So one analogy that I use a lot these days to explain this is I keep saying that institutional DeFi needs something like a Beetle moment. And one of the things that got me thinking about this thesis was this article that got published in Bloomberg a couple of weeks ago, in which said that institutions are warming up to tokenization, like Wall Street institutions, what I mean. But DeFi remains like a sort of gray area, and probably we have a close collaboration and the utmost respect for the Securitize team, and we were aware of BDO since it was in a very nascent state and saw the development of it. But the tokenization space today, you can basically have two phases: before BDO and after BDO. Like I think it was before BDO, the tokenization space has been around since 2017 or so, with very limited adoption. The use cases have been well documented and well known, so nobody invented anything new. And the institutional capabilities were very limited, except in platforms such as Securitize, that they were ahead of the curve, but they also took years to build the right foundation for something like BDO to have an opportunity. So what BDO didn't do, right? It didn't create a new use case. Tokenized funds have been around for a long time. It doesn't offer an attractive return. I mean, 5% is a very average return. And it didn't require a new technical milestone, right? Like all these foundations have been securitized for the most part since 2018. But before BDO, Securitize actually spent years building all those right building blocks. They acquired ETFs, broker dealers, they put the right KYC, AML capabilities. So they created that foundation to give a pro like that even a chance to exist. So what BDO achieved? Well, it was more than anything an institutional stamp of approval in the space. It's a strong alliance between institutional, traditional finance, and crypto, and it offered. What happened was that a lot of the platforms deploying as LPs into that vehicle are crypto institutions, because they see it like the industry should rally behind a vehicle like this, and also provide a bridge to other financial institutions to come to Web3. So on the institutional DeFi space, we need to do the work. And I think ITV is doing its part to build towards something like a BDO moment. Now, how does that work on a practical term? I think, I spent a lot of time thinking about this, and I think there are two fundamental paths. There is a top-down approach, that is what we spend a lot of time doing, that is enabling more financial products on top of the existing DeFi protocols that allow institutions to scale. So that's one path. And the other one that is the bottoms-up approach, that is, can we get institutional grade infrastructure in DeFi? I call this the BlackRock pool, right? Like as a metaphor, right? Can we have something like BlackRock lending market, BlackRock pool in DeFi? So let's break that down. The top-down approach, that is obviously more, let's say, viable from a technological standpoint, is fundamentally think about, we have all these DeFi protocols, can we build financial services products on top that with institutional grade capabilities? Is what the ITV institutional DeFi platform attempts to do. By a mile, we need a lot of help and more parties building on this. So some of the key capabilities that need to be unlocked is capital efficiency, right? DeFi today is very capital inefficient. We need credit that doesn't exist. Limit the capital fragmentation that we have in this space. This concept that I call DeFi traded products, I'll go into that, and more sophisticated risk management. So capital efficiency. Today, everything in lending in DeFi is over collateralized. AMMs are a nice breakthrough from the automation standpoint, but in terms of capital formation, and is extremely inefficient relative to order books mechanics. So we need to work towards efficiency on those markets. So we need to enable constructs like secure leverage, margin lending, things like that allows positions in DeFi to scale within security constraints. Within that, it's just very hard to achieve a multi-100 billion trillion market at a scale. Now, one of the problems that exists in DeFi today from an institutional standpoint is that capital is very fragmented. So it's in many L1s, L2s, blockchains, I'm sorry, DEXs, lending protocols, and the pipes, the communications between those protocols are very slow, are very difficult. So this needs to be solved. All this plumbing that DeFi provides should be completely transparent from an investor standpoint, unless they really want to drill in. But the level of automation that is required to enable simple trades in DeFi is ridiculous. And yeah, it's doable, but it just doesn't scale. And if we want large institutions to scale with DeFi, we need a different level of abstractions. One of the primitive that I think is fundamentally missing in the market today is credit. So credit has been part of every financial market in history, and is one of the cornerstone of the evolution of financial markets. And in DeFi doesn't exist, and it got decimated for the most part during the FTX crisis. So this idea that everything every single operation or a scale or things like that requires a capital is a little bit inefficient. So we need to enable forms of credit for, let's say, the most successful DeFi protocols could borrow money to scale. This is an area that we have been working on. We need to enable semi-collateralized, under-collateralized forms of lending for companies to be able to scale. We know that was part of the crisis and a lot of things that happen, but if you use DeFi as a core primitive and everything is transparent and programmable and automated, there is more than we can do, that everything has to be over collateralized. Like, that just simply doesn't scale. Risk management, that, as you know, is an area that we put a lot of work, remains as a blocker. It remains a blocker for many large institutions to embrace DeFi. And then the term here that we're using is holistic risk management. So there are many protocols that do a phenomenal job managing their own risk building, and I think they're getting better and more sophisticated, and there are less hacks now than they were 2 years ago and things like that. But the problem is that from an institutional standpoint, it's not one protocol at a time. It's not one asset at a time. You need to have holistic views and models of the entire ecosystem, just like you have holistic views of a given subset of the financial market. So those type of products need to exist. And one concept that I like a lot lately is this idea of DeFi traded products, that think about what ETF did for traditional markets, or what ETPs did for traditional markets, what could be done for DeFi. So imagine a single ball that encompasses a number of strategies or integrations with different DeFi protocols with the correct risk return adjustments and balancing and things like that. And that's the entry point for a given institution. Why is that relevant? Is because the level of complexity that exists in today's DeFi market is just prohibitive for most risk managers and institutions in traditional finance. So that's a top-down approach. You have the existing DeFi protocols, and you put all these financial services, building blocks, and things on top and that's what we're doing. And there is a path, right, to attract institutions to that. But there is also a bottoms-up approach. Is, can we start building institutional-grade DeFi primitive? Right, some key capabilities, the three that I like the most is institutional first pools, this idea of synthetic assets, and I think insurance is one that we have been screaming for a long time that needs to be done. So I call this a BlackRock pool, but in protocols like Morpho, Blue, very soon on Euler V2, and in many others, there is this idea you can launch your own market with your own custom risk management policies and things like that. I think UniB4 is going to enable, I'm sorry, AAVE4 is going in that direction. UniB4 is going to enable similar constructs for AMM. Imagine if you can have a large institution to host their own lending market with the right But what that does from the stamp of approval into the market is tremendous because it allows more institutions to come in, and it also works within their risk management frameworks. I think we're a little bit of, we're a long way away from something like that happen. So we need to set up the foundation. If we don't think about this type of solutions, is we're just being short-sighted. Another problem that exists in DeFi today is that you always have to have the capital to execute everything every single time, right? If I want to borrow something, I need to over collateralize it. I need to settle real time. And that's not how markets work, right? Typically, I know we criticize a lot of the 24-hour settlements and things like that, but that enables a number of, in traditional markets, you execute all these trades, and it's not that you're moving capital all the time, and then there is a settlement logic that executes. And yes, that brings some problem, but it's also very capital efficient. And from the DeFi standpoint, something like that will minimize the gas spent. It will also minimize the security vulnerabilities footprint. So one idea of having DeFi protocols that could work with synthetic representations of assets in a custody wallet, or something that could be moved around and settled after the fact. We might be a couple of years away from that, but something like that is going to have to happen if we want to bridge the gap with traditional finance, because having $1 for every dollar that you trade, it just doesn't scale. Like, it's very limited from the type of trades and financial products that you can build. And then one problem that I think should be solved at some point, we dabbled with this idea about a year back, but it's just simply prohibited from the investment perspective for us. I think DeFi requires a new form of insurance. The insurance constructs that we have in DeFi today, they just don't work at the scale that institutions would require. And we can have all the risk management that we want. We have to have it, but I think insurance is the ultimate form of protection against economic and technical risk, and having comprehensive insurance. So the way this needs to be solved, I believe, is working with traditional insurers. I don't think this is a crypto native thing, because it's just too capital intensive. But it's one of those solutions that eventually needs to be put in place. And then I want to close this with a very ambitious idea. That is something that we have discussed internally in our research track multiple times. That is this notion of an institutional first DeFi network. Essentially, think of an institutional layer on top of the existing DeFi infrastructure. So who will be the participants of this network? Well, think about liquidity providers, hedge funds, mutual funds, crypto institutions, exchanges, lenders, and others. Think about market makers that work with specific foundations and DeFi protocols, custodians that can keep your assets safe. If this vision of institutional pools materializes, think about having the providers of those institutional pools, providers of credit. So when I execute a trade and I lever up with certain constraints, insurance protocols, and other parties. And imagine a network of these parties on top of existing DeFi protocols. And then if I'm a liquidity provider, I'm going to supply liquidity to a vault that interacts with Aave, Morpho, and something else. And I can use my funds could be in a custodian. They don't need to be exactly deploying the protocol at real time. I can lever up using a credit provider that will approve my transaction because I'm only using Morpho and Aave, and those are protocols that are trusted. I could be covered with a specific insurance policy based on a specific conditions on the protocols. And this type of network, and network might not be the right metaphor to describe this, but it's something that institutions can use as the first entry point to DeFi. So I think again, where there are attempts like this in CeFi, like what Copper is doing, what Ledger is doing with their enterprise solution. I think what Bigo is doing with the Go network. So there have been attempts to do this. I think an attempt to solve this issue in DeFi is also relevant. So a quick summary before we go to Q&A. I think there are a couple of questions there. There are major challenges for institutional DeFi. Adoption is not about KYC and AML. That seems like a very mediocre excuse. Solving institutional DeFi is going to require two things. One, first, is going to require institutional grade products. Again, I hope that we're doing our part on that side, but I also think it's going to require institutional first DeFi infrastructure, custom pools, insurance, synthetic assets, and things like that. I like this metaphor of working towards a middle moment in DeFi, something that serves as an institutional stamp of approval. I'm gonna go to Q&A, but before that, I want to point you to the next webinar. We're gonna be talking about the evolution of lending protocols from something like Compound to MorphoBlue, right? Like what is the difference? How does that evolution happen? What are all the new forms of lending protocols that we have in DeFi? I think it's going to be run by our head of research, Lucas Otomoro, on September 4th. The link is on the webinar chat. Please go ahead and register. And with that note, I'm going to go to Q&A. So Lilian is asking, some key issues with DeFi is that it's not very decentralized at every level and lacks transparency, and they have their own crypto, meaning their own tokens. And there is calls for regulating DeFi. Yeah, I think that DeFi is more decentralized doesn't need to mean 100% decentralized. I think there is many scenarios in which some centralization vectors are required. I think DeFi is probably the best solution that we have to be more transparent and somewhat decent. I'll pick DeFi any day of the week compared to traditional market infrastructures, but it's not 100% decentralized. Many of these DAOs make discretionary centralized decisions in different ways. Many protocols have centralized controls and things like that, but it's definitely a massive improvement compared to other financial markets. And I think the way to think about DeFi is almost like a parallel financial market, not as a replacement to anything. And in terms of regulation, yeah, I think it's right. I think a lot of this is going to have some regulatory guideline at some point. This is far from being my area of expertise, but I think that's definitely coming at some point. Advanced regulation, Jorge Alberto said, advanced regulation is more important for institutional adoptions on DeFi. Yeah, it could help in some for traditional institutions, but it's non-trivial whether it could hurt as well, because it highly depends if it's a constructive regulatory framework or if it's a harmful regulatory framework. If it's something that is a brute force approach, like every protocol has to KYC everybody and things like that, I think that's going to hinder innovation, and probably protocols are going to stay away from those regulatory jurisdictions. So I don't think it's a very binary thing. It's a very careful needle that needs to be threaded. If in most technology markets, if regulation gets too aggressive and ahead of trends that they don't understand, most of the time, history tells us that it causes harm. So again, not my area of expertise, but I think this is a very constructive regulation could help but aggressive regulation might hurt quite a bit. Andy is asking, do you consider for the bottom-up process a 200-year-old technology like mutual societies will be a good fit for DeFi? So build it and liquidity will come rather than try to shoehorn into traditional finance. I don't know. I don't think that those are exclusive. What we have observed in bootstrapping liquidity is really hard. And it's a cold start problem. And the way that that has been done in crypto is with incentive programs that there has been a 50, like, I don't know, like the success ratio has not been stellar. We have seen blockchains like Polygon or Avalanche had a, DeFi summer and then the activity completely died down. I think having models like what we did with Aave, in which you can accelerate liquidity by what is the term that you say, shoehorn it into institutional adoption, it has value. As long as it's within the ethos and the constraints of DeFi, they build it and they will come. Most of the time, they don't come, right? Like if you think about what are the protocols that have been successful on those, it's very few and far between. And it's not necessarily the most innovative one. There's many protocols that have incredible tech, incredible teams, and they struggle with liquidity. With liquidity formation, it's a very difficult. So I think a hybrid. There are many paths to form liquidity in DeFi. I don't think I have any other questions. So with that, thank you very much for joining. I hope you like the topic. I hope it made you think. And we'll see you in September 4th in the next webinar. Thank you very much.